Good morning and welcome to this RM2 webinar on employee ownership trusts. My name is Nigel Mason. I'm one of the directors of RM2 and I'm joined by my colleague Richard Cowley, who is involved in our EOT consulting practice as a corporate finance director.
Good morning.
We're going to do a rather brisk session today. We're going to record this webinar, so if you do need to drop out before the end, it will be available on our YouTube channel, and we expect the whole session, including time for questions, to last no more than 30 minutes. So EOTs are a fast-growing form of company sale option. And we found when we talk to prospective users of EOTs, business owners of private companies, when we ask them what their objectives are in achieving an exit route for their company, we've listed here some of the typical requirements. And very often owners talk not in terms of maximizing shareholder value or maximizing a return from a sale, but of achieving fair value. And there are very strong, softer objectives that are articulated, such as a desire to keep their business intact, a desire to leave behind a legacy of which they can be proud, very often a desire for all sorts of reasons to exit gradually, partly to continue to support company and partly to decompress slowly from what might have been quite an intense career or in a leadership role. Very few vendors relish the prospect of earnouts and the conflict that they can often result in. And they want to try and minimize risk, not only in the execution of the sale of a business, but thereafter. And there is a strong desire to make sure that employees left behind are well looked after and that successors are suitably rewarded. Very few business owners, I think, would relish the prospect of selling a business in a way that left all their long-serving colleagues deeply disgruntled. So these are the common objectives, of which fair value is only one. And when they're matched against the principal sale alternatives, of which the most common is a trade sale, less common would be a sale to private equity, even rarer would be an IPO. Liquidation, sadly used in situations where no exit route has been found, and the management buyout if there is a strong successor team already in place. Some of these objectives are found wanting, and the EOT, on the other hand, is able to fully address the requirements and the objectives in the left-hand column, as we'll illustrate on this webinar. So we're talking here about a special type of employee benefit trust. I can advance the slide. But employee benefit trusts have unfortunately acquired a little bit of a tainted reputation because of their use in tax avoidance schemes, in particular remuneration planning schemes, of which the most notorious case was involving Rangers Football Club. We're talking here with an EOT of an altogether different type of employee benefit trust. Indeed, it's modelled principally on the long-standing broad-based employee benefit trust of the John Lewis Partnership. And the objective of the legislators who introduced the EOT in the Finance Act 2014 was to, in their words, create a John Lewis economy. There have now been about 300 companies establishing EOTs, of which perhaps the best known is the Aardman Animations studio in Bristol, makers of Wallace and Gromit, whose conversion towards the end of last year to employee ownership obviously attracted a lot of publicity. The desire there was to very much keep that business independent. It had received numerous takeover offers over the years from big studios, including Hollywood studios, but there was a strong preference to maintain an independent Bristol-based operation. So what is an employee ownership trust? Well, fundamentally, it's a discretionary trust for the benefit of all employees of a company. And it comes with two eye-catching tax reliefs, which were introduced to encourage business owners to contemplate this exit option when it was time to sell their business. The first is complete exemption from capital gains tax for people who sell a majority of a company to an EOT. And secondly, the prospect of income tax-free bonuses for employees. And we'll say more about these two tax reliefs in a moment. There are 5 principal qualifying requirements that have to be met for an EOT to be able to offer those tax reliefs. And they're listed here. And we're going to go into each of these 5 requirements now in a little bit more detail. First of all, the EOT must operate for the benefit of all employees of the company on the same terms. But those expressions in inverted commas can be qualified slightly. For example, all employees does allow the exclusion from benefiting employees who've not yet passed a qualifying period of employment, but that qualifying period must be no longer than 12 months. And secondly, all employees must exclude those people who were formerly or are currently 5% or more participators in the company, and that includes people connected to 5% participators by family membership. And that's obviously designed to stop EOTs benefiting in a tax-advantaged way, closely controlled family-owned companies. And the phrase "on the same terms" may suggest complete egalitarian benefit, but in practice it can be moderated by reference to factors such as pay, hours worked, length of service, or combinations of those factors, which in practice can mean that benefits can be directed more towards long servers and higher paid employees if that's desired. In practice, we've rarely found the all-employee nature of the EOT to be a stumbling block when introducing the concept to clients, because as we'll see later, there are some very neat ways of introducing discretionary ownership alongside the all-employee trust. The third requirement is that the company must trade or be the holding company of a trading group. That's self-explanatory. The fourth requirement is to do with control. And in order to qualify for both capital gains tax relief for the selling shareholders and income tax relief for bonuses, the EOT must satisfy a majority of 4 tests. And therefore, it's not just a majority of the share capital, it extends to a majority of the voting rights as a result of those shares, a majority of the profits available for distribution, and a majority of the assets on a winding up. So these tests have to be carefully studied, especially where there are multiple classes of shares in a company being sold to an EOT. And note that the capital gains tax relief is only available in the tax year when the EOT first acquires control. It's not available thereafter. And this encourages minority shareholders often to sell alongside a controlling shareholder. The fifth requirement is perhaps the most obscure, the simplest way we can express it is with a little bit of algebra. The number of people who are both employees and participators, including connected people, must not be less than, must not be greater than 40% of the total number of employees of the company. So this is designed to prevent EOTs working successfully or offering tax advantages in very small family-owned businesses. And it is a test which has to be examined not only at the point of the transaction, but in a period looking back to 12 months before the transaction. And we have had to perform this test in some of the smaller EOTs on which we've advised. So something to look out for if you have a relatively small workforce, but which I would say fewer than say 20 employees. It's worth comparing the EOT tax relief with the entrepreneurs relief that would be available to many business owners and founders, because in many cases it's more lenient and more flexible. For example, entrepreneurs relief requires there to have been a shareholding of at least 5% for now 2 years. It was 1 year until the last budget, whereas there is no such holding requirement or minimum shareholding requirement for the EOT relief. Also, for entrepreneurs relief, you have to be an employee or officer. There's no such requirement for EOT, although, as I said earlier, it's relief only available in the year when control first passes. The nature of the entrepreneurs relief is to reduce capital gains tax from a normal 20% to a lower 10% rate up to a lifetime limit. There is no CGT at all with the sale to an EOT and no financial limit. So it preserves that £10 million lifetime limit for serial entrepreneurs who might go on to do another project. And finally, on the post-sale conditions, well, there are none for entrepreneurs relief, but there is one for EOT relief, namely a continuing majority holding by the EOT. And if that's not met in the tax year following the year of the transaction, it's the vendor that will suffer the consequences of a clawback and not the EOT. I'm going to hand over to Richard, who's going to talk you through the financing of an EOT and how an EOT operates step by step.
Hello again. Right. So the EOT purchased the shares for a fair value or below a fair value, and effectively that can be paid for in a number of different ways. First one on the list there is free cash on the balance sheet. This is a very important benefit of the EOT model because it allows cash which is sitting on the balance sheet to be distributed without any any tax liability to the vendors. Depending on what the value of the price that the EOT buys the business for, i.e. if it is purchased for much below fair value, it may be able to be paid for entirely by cash on the balance sheet. However, the vast majority have some sort of debt which is taken on by the EOT, and that can be broken down to senior debt and subordinated or junior debt. And that can, in the majority of cases, there will be some vendor financing there or vendor loans. If there's a third-party lender, that will generally be the senior debt, with the vendor debt sitting back behind as the subordinate debt. Obviously, the senior debt will in most cases carry a smaller interest rate than the subordinate debt. The private equity investment, this is fairly rare. There are some private equity type financiers out there who are prepared to back an EOT, but this is generally more expensive, covering an interest rate in these days of probably into double figures, and may even have some kind of equity element to it as well. Moving on. Just trying to get through to the next page in the presentation. So this is a breakdown of how the elements of the transaction take place. So first of all, the company will establish the EOT, which is generally speaking a limited company, which gives protection to the trustees who will be directors of that company. And then the fair value is established, which will be some form of valuation. And if there is debt established, there will be payment terms. And the EOT may take a formal valuation of the company, or the trustees may take a formal valuation of the company at that point. At that point, therefore, the shareholders sell the shares to the EOT, and the EOT takes ownership and control of the company So most likely there will be debt within the EOT, where it's funding the purchase, and that will be third party or vendor debt. But also at that point, at the point of the transaction, the balance sheet cash or excess cash on the balance sheet potentially moves through to the vendors. This officially, the company guarantees that effectively it will fund the purchase by the EOT, and therefore the funds are distributed from the company into the EOT and therefore over to the shareholders. It's important that this is not a dividend, as that's not a very tax efficient way to do things, and effectively the funds are gifted from the company to the EOT and then over to the shareholders. The funding carries on through the course of the debt being paid over until such point that all elements are satisfied. The shareholder, in order to protect its interests, may have, as part of the loan agreements, may have a charge over the assets of the company. It will not be a charge over the equity of the company, because that would be close to the control moving back to the vendors and thus dropping out of the rules of the EOT. Once the EOT is set up, employees may receive a tax-free bonus, assuming that funds are available for bonuses to be paid. I mean, it's the nature of EOTs. If a fair value is paid for the company, that obviously the transaction is heavily leveraged, and therefore excess funds generated by the company during the years following the transaction will probably be passed to the vendors in order to finance the loans. But once there's through that, or potentially even while the loans are still being paid off, bonuses can be paid to employees, as Nigel said, on the same terms, up to a value of 3,600. One of the nice things about EOT is it has the flexibility of allowing employees to also subscribe for shares or for EMI share options to be set up. And therefore, if the management team, the new management team of the company, wish to incentivize key employees above and beyond the £3,600 bonus, share options can be granted, or direct share ownership. Obviously, it can only go up to, it has to be below 50% of the share ownership, because the EOT needs to retain control of the shares. And those may be new shares or shares which have not been purchased by the EOT. They won't be purchased from the EOT. So just covering the point slightly mentioned already. So tax-free bonuses, employees in the companies controlled by an EOT can take advantage of a £3,600 tax-free bonus. This is paid to the employees on the same terms as Nigel mentioned. It may be sort of length of service or remuneration, or actually maybe just equally spread amongst all the employees. This is a tax-free bonus, but it does not have any NI relief, and therefore employees and employers' national insurance will still be paid.
We sometimes ask Richard, is it possible for an EOT-owned company to pay fully discretionary bonuses? And the answer, I think, which we give most often, is that provided the base layer of bonuses can be shown to have been paid to all employees on similar terms, that base layer will be income tax free if it falls within the 3,600 limit, and then excess above 3,600 will be treated as a separate taxable discretionary bonus. So this is not binding the company only to pay. It egalitarian bonuses at all. It's just that to get the tax relief, they have to be egalitarian. Just going to move on and expand a little bit on how EOTs can offer share ownership on a more discretionary basis, because we've heard the EOT itself is an all-employee trust. It's quite possible, following the establishment of an EOT, especially if it's taken on a lot of vendor debt, for the share value to be much, much lower immediately after the EOT. And that's a good time for new entrants to be brought onto the share register as shareholders alongside the EOT. In fact, in some cases, the subscription price may be as low as nominal if the acquisition has been entirely financed by vendor debt. It's possible to introduce new provisions which might require any bad leaver subsequently to sell their shares back to the EOT or to the company, but usually the EOT, at cost if they're a bad leaver, and at market value if they're a good leaver. And a helpful provision in the legislation is that a company, even though controlled by an EOT trust company, can operate tax advantage share schemes such as an EMI share option plan or a share incentive plan, whereas normally any company that's controlled by another would not be allowed to operate these schemes. So that's a helpful concession, and one that's used a lot because perhaps one of the neatest ways to get people into discretionary ownership is to establish an EMI scheme through which people can effectively be given immediately exercisable EMI options, the effect of which is to put them into a 10% capital gains tax regime if they hold the options for 2 years, whereas normally that would only apply to 5% or more shareholders. So to summarize and to give time for questions, we see a lot of benefits for EOTs, which suit a broad range of circumstances. If I can get the screen to advance. Vendors get fair value, or can get fair value, and can exit on terms and at a pace that suits them, unlike most other forms of exit route where an external third party will be dictating the terms. Vendors can get full capital gains tax relief, and these are friendly, non-adversarial transactions usually, so there's low execution risk and minimal disruption. And it avoids the prospect of opening up the company's secrets and sensitive information to competitors, which is the rather unpleasant aspect of a typical trade sale. Company remains independent. Founders create an enduring legacy. We should have pointed out that advanced clearance is available. We would almost always recommend that a client seeks a transaction in securities clearance, which would confirm that company money, even though being used ultimately to pay shareholders through the EOT, is going to be treated as a capital disposal, not an income tax treatment. And then employees become the beneficiaries of the business in a sustainable way. And there is now mounting evidence of the efficacy and superior performance long term of businesses that are owned by employees, especially through the trust model. And for more information on that, you should visit the Employee Ownership Association website, where there is a lot of free research information and various other studies. So we have given you a very brisk introduction indeed. This webinar has been recorded and will be shown on YouTube, but those wanting a deeper dive into the subject can obtain a free copy of our book on EOTs. It's a short read, about 80 pages, written by our colleague Gary Karch. It's now in its second edition. So email Richard if you'd like a copy. It's a printed book, so we'll need your address. And also, please do give us any feedback on this webinar that we can use on future occasions. We're very happy to take any questions from any of you. And I think we have one here. I can just the screen. So bonuses to employees. The arrow comes from the EOT. Are the bonuses paid by the EOT or the company? It's a good question, because actually bonuses are paid by the company through payroll and not by the EOT. And that's done for all sorts of sensible practical reasons. Companies obviously got the means to pay bonuses already because it's operating payroll. Although the legislation, I think, did envisage that this bonus was sort of in lieu of or intended to simulate a dividend distribution or a direct distribution from the EOT. So in practice, it is the company. So that's a good question. Thank you. Here's the next question. When a limited company converts to an EOT, does the employer change, or is it still the limited company? The answer is nothing changes in the trading company. All contracts, whether with employees, suppliers, clients, they should stay intact and unchanged. And all that's changing here is the ownership of the company. Of course, one has to look out for change of control clauses that might be embedded in certain contracts that might require approval or novation, but employment wouldn't change. Next question. Can a joint election be entered into so that the employee pays the national insurance liability? Good question. Out of my knowledge, and we will email you with the answer because we know who asked the question. Thank you very much. So you get an email answer to that in the next hour or so. Very good. So because it's coming up to midday and we are committed to keeping this to half an hour, we will finish there. I'm just looking at one or two other questions. Yes, another question has pointed out that payments to the founders use post-corporation tax money from the company. Yes, the contributions to an EOT for the purposes of repaying vendor debt are not tax deductible, but then neither are capital payments on debt generally. How easy is it to obtain debt funding? If you have a business with EBITDA of more than £1 million, then the market for EOT debt finance is beginning to open up with choice. If you have EBITDA of less than £1 million, not only are there far fewer willing lenders, but the costs of obtaining that finance start to get prohibitive. So I think external debt is really feasible only for the larger company. Well, thank you all very much for your questions and for attending. And do please email us for a book and with any follow-on questions. And we hope to see you on a future webinar. Goodbye.